Hi, it's Dr. Meherji. Learn smart, score high always. In this present session, I am going to take the theory base of accounting, in which I am going to explain the key concepts in accounting. As you all knows very well about accounting, it is an art of recording, classifying, summarizing, and interpreting financial transactions and events. So the main purpose of doing all these things is to provide information to the users, whether they are insiders or outsiders. The importance of accounting theory base is to ensure uniformity and consistency. Why? If they are not maintaining this uniformity and consistency in accounting records, the main purpose of the users would be defeated. So thereby they have to maintain utmost that uniformity and consistency in accounting records and to enhance the utility of information for users. In this presentation, I will explain the fundamental concepts that form the bedrock of accounting practice. Before going ahead with this, we have to see this generally accepted accounting principles, widely known as GAAP. It refers to rules and guidelines adopted for recording and reporting these accounting business transactions. We're recording these business transactions, ensuring uniformity in the preparation and presentation of the financial statements. It is very vital for any accounting. So this gap is providing that rules or these guidelines. In India, it is ICAI, the Institute of Chartered Accountants of India. It is the regulatory body for standardization of these accounting policies. Okay, what these principles means? It is according to that oldest accounting standard board in the world, that is AICPA. A general law or rule adopted or professed as a guide to action, a settled ground or basis for conduct or practice. So AICPA defined it as a settled ground or a guide to action or basis of conduct or the practice. So these practices should be kept in mind while drafting this accounting. The principles are not static. These are dynamic, very dynamic. So based on the requirement from time to time, they will change. They will adopt new rules or guidelines. So it is based on that past experiences, usages, customs, statements by professionals, and regulations by the government agencies. So it is fundamentally influenced by changes in the legal, social, and economic environment. So we came to know with this that this gap rules or guidelines will be changed from time to time. These are subject to change. But everyone, while preparing accounts, should be kept in their mind. Basic accounting concepts. We are looking at an overview here in this slide. It is the fundamental idea or a basic assumption. So accounting concepts are the fundamental ideas or basic assumptions underlying the theory and practice of this financial accounting. There are broad working rules for all accounting uh, activities. The main or important concepts are, yeah, business entity concept. Business is separate and owners are separate. Money measurement concept, going concern concept, accounting period concept, cost concept. All these concepts we will see one by one later on. And dual aspect or duality concept, revenue recognition or realization concept, matching concept, full disclosure concept, consistency concept, conservatism or the prudence concept, materiality concept, and objectivity concept. Let us, yeah, in business entity concept, uh, business entity as a separate from its owners. The core idea is business has a distinct and separate entity from its owners. It is the core idea of this concept. What its implication, thereby, for accounting purpose, the business and its owners are treated as two separate entities. Two separate entities. Business is separate and owners are separate. Owner or owners are separate from its business. Thereby, the capital introduced by owner is considered a liability for the business. The owner brings capital in several ways, cash form or any other ways. But all that will be treated as a loan to the firm. Okay, we have given a distinguished name from other loans as it is a capital that indicates it was contributed by the owners. If we show any liability or other loans that are from the outsiders, not from the owners. So any money taken by the owners, withdrawn by the owner for his personal expenses, that would be treated as drawings. That would be treated as drawings. So that is why these two are different. Owners are different and the business entity is different. So that's why we are calling, if they are bringing into the firm anything that we are calling as capital and anything they are taking as drawings. Benefit by doing this is business transactions are recorded in a business books, not the owner personal accounts. Okay, owner personal accounts are different and business, its transactions are different. That is the core idea of this business. In money measurement concept, the transactions which are measured in terms of money only can be recorded in the books of accounts. So you see this, only those transactions and happenings in the organization that can be expressed in terms of money, are recorded. If which cannot be expressed in terms of money, they have no room in the books of accounts. It is a very clear. It has an exclusion. That is, even that cannot be measured in monetary terms, such as, that is the exclusion, quality of management, uh, which is highly required for any business organization for its success. Employees' moral. It is also very prerequisite for any organization's success. Though these are not recorded, even if they are important. Quality of management is important, employees' morals are important, though we are not recording in the books of accounts. Unit of measurement. Money provides a common and convenient and understandable unit of measurement for any financial data. So that is why we are recording all that business transactions which can be expressed in terms of money. A significant aspect of this concept is that it assumes the value of money remains stable over time. Okay, still many users of this accounting data, okay, whoever making investments in the stock market, they are comparing these financial statements over past 5 years or even past 10 years and so. So here they are forgetting that rupee value, it is depreciating, inflating. Inflation is playing a vital role. So why or how they can compare these figures over 5 years or 10 years and beyond? So the major limitation of accounting under this concept is that another one is inflation or that deflation. And now going concern concept, how it assumes even all the owners of the business are dies, the firm still will go on. Their successors will come into their shoes in the firm and the firm will still continue. It has a perpetual life. That is the core idea of going concern concept. Continue to carry out its operations indefinitely. It is the core idea of this concept. Implication, it is crucial for valuing assets. We record the value of assets at a historical cost, not in their liquidation value. Why? Because it is assumed they will be used to generate revenues over time. So for instance, here we purchased an asset for 50,000 and estimating its life for 5 years. The cost we will spread over these 5 years, assuming the business will continue for at least that period. Okay, machinery will collapse by expiry of 5 years, but the business still will continue. It is going concern concept. Accounting period concept. Accounting period concept. Life of an enterprise is divided into specific time intervals, typically a year. What the purpose? Financial statements, profit and loss account of balance sheet are prepared at the end of each period to provide timely information to the users how this business unit is going on. To know that, Earlier assumption that concept is saying it is having a long lasting life. When to know its performance, not at the end of the business unit, so life. So thereby at the regular intervals, that is year. Typically that year would be April 1st to March 31st. It is for the purpose of taxation also. Benefit is assessment of performance and financial status, aiding decision making. So it is the main idea behind this accounting period concept. And another important concept is this cost concept. The core idea is that all assets are recorded in the books of accounts at their purchase price. Purchase price. Okay, which may include the cost of acquisition, transportation, and installation, etc. But it should be at purchase price. Thereby, it is known as a historical cost. The objective is the objectivity. This concept ensures objectivity because the purchase price is verifiable through source documents like invoices and all. So market value, it may vary based on that assets. It's not reflected in the books of accounts. The original cost remains the basis. Example, okay, say for instance, we purchased a land in a prime area for 50 lakhs and we will record at 50 lakh only, even though it becomes 1 crore or 1.5 crore later on. It is the cost concept. So that verifiability, objectivity should not be defeated. So we will write the cost price only, that's purchase price only. A dual aspect concept, a duality principle. Under this, a fundamental principle of accounting, every transaction has a dual or twofold effect. Every transaction has twofold effect. One debit and another one should be automatically credited. So it is the formula for base for accounting equation, that is assets is equal to liabilities plus capital. Under this dual aspect concept. So every transaction, whenever we are recording, one aspect is debited and the other is credited, thereby ensuring that for every debit there is corresponding credit leading to balance. Example we have seen here, 50 lakh cash. We started a business that indicates cash, it is an asset, will increased by 50 lakh and it is a RAM's capital, owner's equity, it is increased on liabilities side 50 lakh, balanced. And in revenue recognition or realization concept, core idea is recognized when the legal right to revenue is arises, not depending on the receipt of the cash. Okay, when to write an entry, whenever we supplied goods or services, then immediately there is a legal right to the firm to receive against that service or goods or cash to receive. So whenever that is happened, they will write this entry. But it has an exemption in case of big projects, long term contracts like constructions. In that case, revenues may be recognized on a proportionate completion basis. In long-term contracts, okay, that may take completion may take 5 to 10 years. In that case, how to write the transaction when that legal right arises to receive a cash, okay, that is based on the completion. But in many other cases, okay, these services are the supply of goods, okay, in a short span of time, which would be completed within that accounting period. So thereby there is no problem for all that transactions, except in case of long-term projects like construction. There we are taking the revenues would be recognized on proportionate completion basis. And in all other cases, recognized when the legal right to receive it arises. That is revenue recognition or realization concept. And another one is matching concept. In this, expenses during that period must be matched with the revenues earned during the same period. So expenses and revenues should be matched. Then only we will get a correct picture of the financial position or the financial results we can came to know, whether they incurred profit or loss, or what that exact position, financial position we can arrive. So that is why matching concept is very, very important. Under this concept recognizes recording expenses that relate to revenue generated in that period, regardless of when cash is paid. Okay, cash may be paid later on, but whether that expense is relating to that income or that income is relating to this expenditure, that would be matched under this. Benefit, it ensure accurate calculation of profit or loss, and thereby that associating the effect with the accomplishments. That is why under this concept we are recording this depreciation against the assets to match that revenues and that expenses. Now it is the turn to full disclosure concept. Full disclosure concept. In this, the financial statement should reflect information fully, fairly, and adequately. It should disclose all that material and relevant facts in it. Thereby, it will give the total financial performance and position of the enterprise. The purpose is to make the proper and informed decisions based on the comprehensive information. They are giving this full disclosure. They are giving as whenever required in footnotes also. Footnotes to the financial statements. And again, this full disclosure is mandatory under this SEBI, Securities Exchange Board of India, and under this Companies Act also. They are suggesting that full disclosure. Thereby, the users can take informed decisions. In consistency concept, these accounting policies and practices should be applied uniformly from one period to another period. If they are not following, they are not maintaining consistency like this, we cannot compare these figures from one period to another period. Thereby, this consistency is required. Thereby, the benefit is it allows for meaningful inter-period comparison of the financial statements. Help to assess trends in the financial performance and positions. Thereby, consistency is required. And example, if a company adopts a specific method for inventory valuation or a depreciation, it would continue to use the method consistently over time. For calculating or valuing inventory or to follow depreciation, there are several methods. The firms can choose any method which is most suitable for their firm, and that should be followed consistently. Consistency is required. If any change is there, consistency is important, but sometimes a change is required. Example, for better presentation. In that case, they can change from one policy to another policy or one practice to another practice, and that should be disclosed. The changes, such changes and their effect must be clearly disclosed in the financial statements. Conservatism or prudence concept. The core idea is profit should not be recorded until realized. You don't anticipate the profits, but all known and even potential losses should be provided for. It is the conservatism or prudence concept. What that is? You make all provisions for the losses, but don't anticipate the profits. Its application, it reflects a cautious approach, aiming to avoid overstating profits or assets. Thereby, closing stock is valued at a cost or market price under conservatism or prudence concept. Whichever is lower, closing stock value at cost or market price, whichever is lower, with this conservation or prudence concept. The provisions are made for all doubtful debts. With this, the investors or stakeholders' interests would be protected, especially for creditors, by ensuring a realistic and not overly optimistic view of the firm's financial health. And in materiality concept, all material facts that means significant or relevant enough to influence the decision of the informed users, that should be recorded and disclosed in the financial statements. Again, it is a subjective one. It depends on the nature and amount of the item in question. The application is immaterial items may be treated in a similar way or even ignored. For example, the cost of small items like pencils might be expensed immediately rather than capitalized. They may use it for coming year also. In the next year also, they may use this stationery, but they won't capitalize it. Simply, it will be expensed. Benefit, it helps in presenting concise and useful financial information by avoiding clutter with insignificant details. All that. Majority, some example they are saying calculators, whether they are machinery or stationery. So, item, by hearing its name, it may be a machinery, but value is very small. So, thereby it is not advisable to capitalize it. It is better to expense in the same way. and objectivity concept. In this concept, all these transactions should be recorded in the objective manner. That means free from the bias of accountants and others. There should not be any bias while recording these transactions. What that is, this is achieved by relying on verifiable source documents. What it is, you don't write entries as you wish. That should be supported with the evidentiary documents. Example, these vouchers, invoices, receipts that provide evidence for the transactions. Thereby, reliability will enhance. It ensures that financial statements are based on factual data and is reliable, enhancing the credibility of the accounting information. Example, if we purchase any asset that is recorded at the price supported by the purchase invoice, not an arbitrary estimates. With this, we can conclude that these accounting concepts, these rules or policies from the theoretical framework underpinning the practice of accounting. Adherence to those concepts ensures financial information is more reliable, more comparable, and more relevant. And this provides a common understanding and approach to recording and reporting financial data, which is crucial for informed decision making by all the users. Thank you.